Robert Kiyosaki and Warren Buffett, two legendary figures in the world of finance. They've transformed how people view money and investing. Millions swear by their advice, but their approaches are vastly different, almost like night and day. One champions bold moves, the other steady growth. So, who's right? This isn't about picking sides, it's about understanding their core philosophies. Kiyosaki, known for his bestseller Rich Dad, Poor Dad, urges you to break free from the traditional work-for-money cycle. He pushes you to build assets, things that put money in your pocket. Think real estate, businesses, or intellectual property. Buffett, nicknamed the Oracle of Omaha, takes a more conservative route. He advocates for long-term value investing. This means buying undervalued stocks in solid companies and holding them for years, weathering market fluctuations. Think Coca-Cola or Apple. Both paths can lead to financial success, but the right one for you depends on your individual goals, risk tolerance, and financial situation. Kiyosaki's philosophy centers on building wealth through assets. He emphasizes financial education. He wants you to understand how money works, how to make it work for you. This might involve taking calculated risks to escape the rat race. He encourages investing in assets like real estate. Rental income, appreciation, and tax advantages are key in his strategy. He also advocates for starting your own business. This provides control over your income and potential for significant growth. Kiyosaki isn't afraid of debt, but he believes in using good debt strategically. This means leveraging debt to acquire income-generating assets. Think using a mortgage to buy a rental property. His approach is active, requiring constant learning and adaptation. It's not for the faint of heart, but can be incredibly rewarding for those willing to put in the work. Warren Buffett's investment strategy is the epitome of patience and discipline. He's all about the long game. He focuses on identifying undervalued companies with strong fundamentals. He then invests heavily and holds on to those investments for years, even decades. He stresses the importance of understanding a company's intrinsic value. This means looking beyond the stock price and analyzing its financial health and future earning potential. He's not swayed by market hype or short-term fluctuations. Buffett is a firm believer in diversification. He advises against putting all your eggs in one basket. His portfolio includes a mix of companies across various sectors, reducing risk. His strategy requires patience, research, and a long-term perspective. It's about slow, steady growth, like a snowball rolling downhill, gaining momentum over time. In this section, we delve into the clash of the titans, risk versus return. Robert Kiyosaki and Warren Buffett represent two distinct ends of the investment spectrum. Kiyosaki's approach involves higher risk, but the potential for higher returns. You're actively building assets, creating multiple income streams. This resonates with entrepreneurs and those seeking to escape the traditional workforce. On the other hand, Buffett's strategy is more conservative, focused on steady long-term growth. It's about minimizing risk and letting your money compound over time. This appeals to those seeking a more passive approach to wealth building, content with slow and steady returns. Imagine two people investing $10,000. One follows Kiyosaki, buying a rental property with a mortgage. The other follows Buffett, investing in a diversified portfolio of stocks. The first investor might experience faster growth, but also faces risks like market downturns or tenant issues. The second investor sees slower, steadier growth with lower risk. Neither approach is inherently better. It's about finding the right fit for your individual goals and risk tolerance. Choosing between these investment giants isn't about declaring allegiance. It's about understanding your own financial personality. Are you comfortable with risk and actively managing your investments? Kiyosaki's approach might be your calling. Do you prefer a hands-off approach, letting your money grow steadily over time? Buffett's strategy could be your guide. You can even blend elements of both, tailoring your approach to your specific goals. Start by defining your financial goals. Are you saving for retirement, buying a house, aiming for early retirement? Once you know your destination, you can choose the best vehicle to get you there. Assess your risk tolerance. Are you comfortable with market fluctuations? Can you stomach potential losses? Your risk appetite will heavily influence your investment decisions. Remember, investing isn't one size fits all. Kiyosaki and Buffett offer valuable lessons, but it's up to you to apply them to your unique situation. Start by educating yourself, read their books, understand their strategies, and see what resonates with you. Don't be afraid to start small. You don't need a fortune to begin investing. Even small, consistent investments can grow significantly over time, thanks to the power of compounding. Consider seeking guidance from a financial advisor. They can help you create a personalized plan aligned with your goals and risk tolerance. Remember, the best investment you can make is in yourself.